Hey, it's Andrew here from Mortgage HQ. We've got Nick from CoreLogic. He's head of research at CoreLogic. Correct me if I'm wrong.
Yep, that's right.
You've been there a while. Why don't you tell us what you do?
Yeah, kia ora, Andrew. Well, thanks for having me on. Yeah, so my role is head of research. I've been in the role for about 4 or 5 years. Pretty interesting role. And I suppose to step it back one little bit, working for CoreLogic, and CoreLogic is a property data and analytics company. And I suppose at the core of what we do is bringing data together from all different disparate sources and then trying to make sense of that information to then provide it to clients and anyone that needs property data and insights. And so my role is then to take that information and tell the story about what's happening in the property market. So we deal a lot internally, educating our staff and especially people that are client facing, deal directly with our clients. So the big banks are obviously some of the big clients we have, real estate agencies, insurance companies, government also a big client. So presenting to them and then doing a lot of media work as well. So, in that consumer facing role as well, where we're talking to media on a regular basis about what's happening in the market, which can be quite interesting. It's a very crowded market. There's a lot of opinions. And so we'll try and get our take out there as well.
Yeah, look, a lot of the economists these days are getting somewhat of a celebrity status, and been thinking a lot more about that lately, and especially the economists that are getting paid to speak or paid for their opinions. A lot of those fees are coming from people that have a lot of vested interest in what's going on in the market. And so if you're constantly getting paid to speak or comment for a company that really needs the economy and the property market to be in a strong position, whether you realize it or not, is going to bias what you're saying. Because if you're like the negative Nancy, always, you won't get invited back. And so one of the reasons I love reading from the source of the data, which you guys provide, is it's quantitative, and it's not with the same bias, because you guys are trying to tell it like it is based on the data without trying to sell yourself on top of it. There's less vested interest, and you can't really hide from the data. There's only so many ways you can color outside the lines of what the data says.
Yeah, I love that's bang on. And I'm glad you said that, because that's something we sort of pride ourselves on, is independence and always having a data back, behind us as to why we get to our final decision or conclusion as to what we think. And so, as you say, we want to pull that information together and then take people on that, journey to understand why we think the way we do. And if you disagree with some of our underlying assumptions or the data that we're using to arrive at that conclusion, then that's okay, but we'll certainly, let you know why we think the way we do and the reason behind that. And then you can take your opinion based off the back of that. But we certainly do try and remain very independent of what's going on. And we've certainly got no stake in the game for what the market does one way or the other. And so I'm glad it seems to come across that way, because as you say, there are certainly some commentators out there which could be more involved in the industry or otherwise. And you can sometimes pick that apart with some of the things they say. So very true.
Yeah, and then that's not even taking into account the politics, which is a topic for another day. Look, I was just having a look at the articles that you've recently written, or at least commented on CoreLogic. So I've got house price index shows NZ housing downturn deepens, rate of fall comparable to depths of the GFC. And the next one, or previous one, is house price index shows property values falling at fastest pace since the GFC. So it seems to me like the data is telling you that the property market is going down or has hit a bottom.
Yeah, so it's certainly on the way down, and it has been for a little while now. And I think we naturally can't get away from that comparison to the global financial crisis. I think it is worthwhile acknowledging that the market is very different right now, and what was causing the downturn back then was quite different. But I think that's why that context is so interesting, to say, well, at a time back then when there was a genuine crisis, the banks were in trouble, there was high unemployment, and the property market was falling at a rate that was comparable, or actually is worse right now, despite the fact that we've got a pretty strong labor market. And the thing affecting the market right now, even though credit's available, it is harder to get, and it costs you a bit more than it did in the last couple of years. And that's a very different situation than back then. So to see falls at that rate is really interesting, but we do need to also fill that picture up with a bit more context there, because it's not quite the same as just saying, well, it's panic time, because we're seeing the property market fall at a rate that we're seeing, at a time when the market was in real trouble, as it was in 2007, 2008. So there's always a bit more to that, I suppose. And we don't always control our own headlines in the research team.
The editor's choice.
There was always a little bit of editor's choice there to obviously make sure the media pick it up and can understand some of of the context there. And, there's always a little bit of headline grabbing probably, but as I said, there's always the detail behind it for those that are keen and able to look into it.
Yeah, I mean, let's dive into that detail a little bit, and I think a lot of the 12-month data is building on that 40% pump that we had, and so of course, reversion to the mean being the way that it is, you're going to see us go below that trend line, and the magic question is when the trend line goes back towards the average, and that's hard to pick, isn't it? And so how do you think the interest rates are affecting the property market in New Zealand at the moment?
Yeah, I think your first point there about the direction of the market right now obviously is on its way down, but it is coming after such a strong period of upward growth as well. And it's really interesting. I think that's one of the things we're sort of making quite clear in our presentations right now is we'll have that chart up behind us, and you can see that exceptional rate of growth in the last couple of years, as you said, 40% or more over that 2-year period. Yes, things are now tracking downward at a similar pace. But when you draw a line from the most recent month back to when property started to grow in about June of 2020, if you looked at that track of that line, it would actually still be a pretty strong rate of growth. And so, yes, it's been through a massive upcycle and then coming back down. But if you put it in that context, it does sort of make things look a little bit more, give more perspective, I suppose. And mean that we shouldn't necessarily panicking with that massive up and massive down. And of course, we are coming from a period of just such a crazy period, and I think one of the things we're trying to do now is reset our minds to go, that market has to be forgotten. We'll likely never, ever see anything the likes of what we saw the last 2 years. And that's what's influencing the significant turnaround or correction in values right now as well. So I think that's important context as to what's happening on the market right now. And then, when we talk about interest rates and their effect on the market, look, in its simplest form, I suppose, depending on where interest rates are at, that affects how much you can borrow. And if you can't borrow as much because interest rates are higher, that affects how much you can pay for a property. And that really is the key, fundamental right now, which is influencing values and the fact that they're on the way down. That people, how much they could borrow in, say, November last year, interest rates were still relatively low. Now they're higher. You can't afford to borrow the same amount of money. And vendors and borrowers know that, of course, and vendors know that. And so we're just seeing this adjustment in expectations between buyers and sellers for where the market is meeting, because people cannot afford to pay the prices of last year because they can't get their money from the banks. And that's the real influence of interest rates, that you can't borrow that money, you can't pay it, and so values have to come back.
Yeah, I know. Even with the properties that we own, we've seen rent expectations go down. Obviously, cost of ownership has gone up, and it's just really important to make sure you're not you're missing weeks or even months of not having tenants, because that costs you a lot more than it used to. So there's some tenants definitely getting a much better deal than they would have a year or two ago, and that's just the market at work, and that's got to be a good thing.
Yeah, I think so. And that rental market's probably being affected a little bit later than what the actual buying and selling of houses is. But that is certainly reflecting the fact that we're seeing this change now. We're seeing an increase in rental supply, maybe because people can't sell their property, so then they put it into the rental market. We are seeing a reduction in demand as some Kiwis, especially those younger ones, look overseas for either an OE or to move to Australia. And so rental demand has come back a little bit as well. And I think that power is starting to turn. And as you say, that growth in rental prices will have to come back a little bit as well. And as you say, the cost, it's not always about money either for a landlord. They need to look at, if I raise it too much and then it goes vacant, that's going to cost you a lot more in the long run too. And the value of a good tenant is what we always hear from property investors. The value of a good tenant cannot be overestimated. And so you're much more likely to keep that rent lower than it probably otherwise could be, to keep them happy, to keep them in the place and not have to worry about going back to market, because that just increases the cost so much at a time where we know everyone is struggling managing costs at the moment, regardless of what your job is or what you do. And so that's certainly something that's influencing those investors' decisions too.
Yeah, even people with money are really worried. So if you have less money or not much money, then I can definitely understand the worry.
Exactly. Everyone's getting squeezed, right? No matter where you are. So obviously it affects some more people more if you're at the lower end of the equity scale, but it does affect everyone. And so they are making those decisions based on those factors that are affecting everybody.
Yeah, I noticed this week there was a bit of talk about how New Zealand's missed a recession. And I kind of have to laugh because of two things. One, I think the data is obviously behind, where we are today. Now you tell me if I'm wrong, but at least 1 month, if not 3 months, the data is
Almost three
not
months.
yet. Yeah, yeah. And then the second thing is technical recession versus actual recession, depending on which industry you're in and how much forward orders you've got. Like the technicality of recession and the feeling of low confidence, regardless of whether you're an owner or an employee,
Yeah.
is another thing. What are you guys seeing?
Yeah, I agree. And I think our chief economist, Calvin Davidson's made this point. He goes, does it really matter if we drop into a technical recession or not? If it felt like a recession at the time. And you're right, we're now almost at the end of Q3 and we just got Q2 GDP data. So it is backward looking. It was back then. It certainly felt like a recession. People were struggling at that time. We know that inflation was obviously huge at that time and it still hasn't really gone away. And that pressure on people has certainly affected them in the way they've been spending and acting in our economy as well. So I tend to agree. We might have avoided a technical recession, but ultimately it felt like it. Things seem to be improving right now. The borders are fully open. We've got these industries that have suffered for so long in hospitality and tourism that can now start to operate a bit more closer to full capacity. So things will likely start to improve, but it did feel like we're in a recession for the first half of this year, but of course it was almost 3 months ago now. So we've kind of moved on and to some degree as well, and thinking about how the rest of the year plays out and what 2023 looks like already. So yeah, it almost like, what does it matter? It felt like it. It's backward looking. So we've moved on.
Yeah, I was noticing in Tony Alexander's little Tony's view yesterday about the difference between South Island and North Island. And what are you guys seeing is the difference between the North and the South at the moment? Maybe Auckland, Wellington's place to start, and then talk about some of the smaller cities of Taranaki. I saw some big outlier numbers there.
Yeah, absolutely. So I think the way we're kind of categorizing the way the market is performing right now is typically we're saying there is greater weakness in the main centres across Auckland, Wellington, and Dunedin in particular. But there's not many centres that are getting away from this current downturn we're in. And then if you go to the next tier of cities, I suppose, we're sort of lumping it into Central and South North Island, as well as a bit of Hawke's Bay, are certainly seeing greater weakness. And then you're seeing the South Island sort of do okay in the most recent pieces of data, particularly that Christchurch and Canterbury region. But you're still seeing some areas hold up better. In the North Island too, particularly New Plymouth is holding up okay. Whangarei is actually not looking too bad. And then you've got Queenstown, which is kind of this market all on its own. I mean, I'll never probably get my head around it, I don't think. Highest average value in the country, relatively small city, of course, but it is a true international city. So it kind of, it kind of works to its own beat, I suppose, as opposed to all the other cities, which tend to be influenced by the key fundamentals of credit availability, population growth, how many properties we're building, how's the economy going, all those things. Queenstown sort of seems to be on its own. So we almost have to put it in its own little basket and talk about everything else separately.
That's what economists and analysts do, right? Is they take out the outliers.
Exactly. Exactly.
Nice smooth line.
Yeah, that's it.
So property prices based on evidence from the past or your previous experience, like where do you think we're going to be in 12 months? Come on, put your name on it.
Yeah, that's right. Yeah, we don't shy away. We don't have official forecast. We don't have a full model of sales value of properties. We do forecast volumes of sales, which does have an influence over values, but we don't ourselves have a forecast of values. We do tend to look at everyone else's forecast and go, yeah, that one feels right, that one doesn't feel as good, or we get the reasoning behind certain models and others. In terms of how we do, I suppose, come to our predictions and our reliance on previous performance as well, I think one of the key things, and we sort of touched on this at the start, was that we can't avoid looking into how markets have performed in the past and help this inform where we think the market might go in the future. But I think the simple thing for us is that you can never be as simple as saying the market will double in value every 10 years just because it's done that in the past. It's done that for a reason. There's always been a reason. Now, whether that be the increase in double income households over a 10-year period, whether that's because we had a fundamental shift downwards in interest rates, which allowed people to borrow more and pay more for property, or because it's the swelling of populations that's occurred over the last, 3 decades or whatever it's been. There's always been a reason, and we can attribute that growth to something. So the key then when we look forward is to go, well, do we see any key fundamental shifts in these things that influence where prices might go in the future. And I think it's hard to find those key reasons. And maybe we wouldn't have been able to find them in the past either. And something will come along to influence prices to go up again. But I think right now, what we think is that the downturn that we're in is likely to continue as long as interest rates continue to increase as well. Now, with the official cash rate forecast to continue to grow upwards from 3% right now to somewhere around 4%, but the flow through to short-term interest rates to be relatively limited because most of those short-term interest rates have already factored in increases to the OCR as well. So we don't think there's as far further to go in the short-term mortgage interest rates over the next wee while. And so that should at least not reduce affordability. And so that might mean the pace of the slowdown slows down. So we don't see the rates of fall at the same rate we've seen the last couple of months. And things get to sort of maybe plateauing into next year as interest rates top out. And I think that's when we start to say, well, then values won't necessarily keep falling, but we don't see them bouncing back because we think the market's so influenced by affordability, which is still very stretched right now because prices got so high, interest rates have increased off these ultra low levels, and that's going to influence how much people can borrow as well. So we sort of see a plateauing of the market into 2023, which could last for a year or two, really.
Yeah, unfortunately, I think it has a lot to do with the election at the next year, just the different priorities of the government options. If we have continued what we have now, then probably it wouldn't surprise me if property is flat or down for a much longer period. If we have a change of government that is more focused around people that earn decent money, then hopefully we get a return back to like a reasonable trend growth because of the service that is provided of property owners to people that need a place to live. The healthy homes is a perfect example of, it's a good intention, but if you want to use a property manager, you're probably going to have to spend a lot of money up front to get your property healthy homes compliant, which a lot of people won't do, which means you're faced with the decision of, okay, I got to manage my own rentals because property manager won't do it because it's not compliant. If I manage my own rentals, I'm doing it in a non-compliant way, or I got to sell the property, and it's not a fun decision to make, no matter which way you go. The right intention, but poor outcome for certain. There's probably less rentals on the market, but because of it.
Yeah, I mean, it's a really interesting space, right? And I think the election, of course, will be really interesting. I think one thing, a tight election, if people don't know quite which way it's going to go, the first thing that does is reduce activity because people don't act in an unknown market or a market with uncertainty. So that could slow the market down in terms of transactions, which will likely see values not increase at the same rate. Then, of course, it'll depend on who wins the election. If it is a Labour-led government, then we might see more of a plateauing of values and not so much growth in the market, whereas National have talked about repealing quite a few of the changes which have come in the last couple of terms for government. They might actually see more attractive for property investment, and so we could see some level of growth return sooner than otherwise would have happened. And that'll be an interesting one to see play out, but not necessarily locked in either. So certainly be one to watch for. But I think the first thing is to see that the market is likely to go into not quite hibernation, but certainly see reduced activity through that. But there's no doubt right now that the market as a investment tool for property investors and, as I said, landlords and property managers is much less attractive now than it has been in the past. And so you haven't got as much activity from those investors because it is harder to make the sums work, and you have to be much more longer term looking to make the profits work. Whereas in the previous, short-term capital growth could make that much more appealing, and you also probably got a much more better yield as well when prices were lower. So there's a number of factors working against them for sure.
Yeah, it makes it sound like a terrible decision to buy investment property, but I still think it's the best thing for most people compared to the alternative options. And it's just all about the price and the yield when you're going in, the day you make that decision, and commitment to long term. And I think 10 year to 20 year mindset, owning property is still the smart decision, regardless of government, regardless of interest rates. You just got to make sure you get the right deal when you're doing it.
Yeah, I think it's a relative term, right? It's tougher now than it's been in the past. But as you said, the question's got to be for that individual, where else would you put this money? Or can you leverage, your current equity to be able to buy other investments? Not often. So that's why property obviously remains so attractive. And then, of course, generally the long-term growth will come back because it will follow to some degree our level of household income. So if incomes increase over time, that increases the borrowing power of people, and that's likely what will lead to key long-term growth in the property market. As well as we all earn more money, we can all borrow more money, and then those people that are acting in the market can pay more money for property too, and that's likely to lead to some level of gradual growth coming back at some stage in the future once affordability starts to improve a bit more, when we stop seeing interest rates increase anymore. So yeah, you're right, it's all about balancing things out and comparing to other forms of investment, whether that be returns elsewhere or the fact you can leverage or levels of risk elsewhere as well. And, many people love property as well because, it's a physical asset. It's the bricks and mortar. You can go and see it. If all else fails, you can probably live in it yourself. So I think that those are the things that also attract, it's not just financial when it comes to property. Many people will weigh up all those extra factors, and that's often why it's proved so popular and in the past, and it's probably likely to do so in the future too.
So how is inflation impacting your guys' assessment of the data and your predictions? If inflation's 2% for 20 years and then you're projecting 2% for 20 more years, it's pretty easy. But when it's 2%, 5%, 10%, I don't imagine there's a lot of conversation you guys have.
Yeah, absolutely. Yeah, I mean, the key influence of inflation, of course, is that if inflation's high, that's just going to keep the pressure on the Reserve Bank to lift the official cash rate to try and slow that inflation down. At some stage in the future, though, they might have this problem on their hands where if they see the economy is still struggling, inflation remains high, and then the property market continues to falter, which does reduce people's equity and how much they want to spend, because if their property value is going down, they feel less confident, they spend less. Then that could also be a time where the Reserve Bank starts to go, man, we've actually got to start to weigh these things up. We can't just keep lifting the official cash rate to fight inflation. We need to consider all the other impacts of that too. So there's a lot of factors there that are going to influence where that goes in the future. At the moment, most economists, and I tend to agree with this, is that we're probably past our peak inflation rate on an annual basis, which is around about 7.4%, I believe, it might be higher, 7.8%. Haven't looked at that for a while. But the key reason being that for that rate to stay that high, we'd need to see Q3 inflation upwards of about 2.3, 2.4% to keep up with the inflation that was in Q2 of 2021. For the annual rate to stay at that level. So it might come back a little bit, but it's also important to recognize that's a rate of inflation. So things aren't going to come down. They're just not going to be growing at the same rate that they were at the end of the previous quarter. So I think that's an important one to recognize. But we do think that, the economy is starting to slow down, that inflation rate is hopefully going to be managed to some degree by this official cash rate lift. And so that starts to reduce in the future. And again, the flow through the property market means that interest rates stop increasing. And so affordability doesn't worsen, and we can start to see values stop falling in the future as well. So it's taking all those factors in, and we haven't even mentioned things like population and how many properties we're building either. There's all those factors that obviously underlie what's going to happen in the future too. So there's plenty that goes on in the background, that's for sure.
Well, you're optimistic. Inflation, I got my fingers crossed that it doesn't blow out, but I'm not so sure. Just seeing as how much of New Zealand being a price taker on a lot of things, if the world goes into more tension between these big countries, then it's reduced supply. It's going to put pressure up on everything. So these secondary countries that manufacture things in, say, if it's not coming out of China, now it's coming out of Vietnam or India, there's more demand on those secondary ones. It's the price goes up for everything. And even internally, New Zealand, labor costs going up. If you look at what the changes have been, is sick days have gone from 5 days to 10 days. That's a cost on business. There's more public holidays. That's a cost on business. There's definitely more sick days of like children being sick and like people taking unpaid leave and so there's a lot of costs on business that are pushing up inflation locally. And bearing in mind, I'm guessing 80% of the inflation we have in New Zealand is not controlled by what's happening in New Zealand.
Yeah, no, I think There's some great points in there, right? And of course, there's uncertainties, as you say. The conflict going on in Ukraine is a key uncertainty as to where that heads, and there's no doubt the influence that has on global economies, including New Zealand. So, plenty of uncertainties in there. I think there are signs that some of those pressures have been reduced. Talking to the building industry, generally supply has come back, which should stop the growth in the prices in that sector as well. So, I think there are signs of things improving. No doubt things can balloon out once again. And obviously, China's gone recently back into lockdown as well, and that'll influence the manufacturing coming from China. So, there are plenty of global uncertainties as well. That'll influence where inflation goes. But as I say, I think there's some local factors that have also improved, which mean that hopefully inflation on the latest quarterly data won't be as high as it was a year ago, and that should bring that annual rate of inflation down. But you're right, let's wait and see. Well, it's probably another month or so before we get that data, and there'll be plenty of interest in it for sure. And maybe I'm optimistic, and maybe overly so, but I think there are signs there that we could be getting to a better state, and that the increasing of the official cash rate, which has influenced people's spending in New Zealand, should hopefully influence that as well. And I'm not sure the rate of imported to local inflation rate, 80%, I think seems too high, but there's no doubt that most of it comes from overseas. And so, there's not much control we can have over those, even if we are lifting the official cash rate itself. So, plenty to watch out for there. And lots of things, of course, affecting everyone in their day-to-day life. And that's probably the hardest thing to get a bearing of.
Yeah. So in terms of specifics around section sales, new builds, existing properties, is there anything that you think's interesting at the moment? Doesn't have to be mortgage related, but I saw a piece talking about Canterbury sections recently, and there's a lot coming in the market. Something to be worried about, section sales?
I think that there has been a lot of properties or sections, like you say, open for development, and a lot of people in the last year or so will have bought sections or even properties with with a house on it, but have it angled for development. And we know there's been some liquidations in the development and construction sector, which has people a little bit worried. But we don't think that it's got to a level that is really panic stations just yet. We have seen in some areas that had really strong development, we're seeing values come back much faster in those areas. I'm talking about places in Wellington, particularly in that lower Hutt region, also down south of Auckland and Manukau, where there has been a lot more development happening. And these areas have seen prices come back a bit further. And that is because of all the properties that have been bought with the promise of development. And then, of course, when the market starts to turn, all those people, and you maybe can't get the labor and the building to actually, the builders to build those properties, the people start to go, man, if it takes longer, can I really afford to hold this property? Do I have the cash flow to hold on to everything to actually build it, which is going to be a bit down the track because I can't get the people to go and do that. So these markets have certainly got more vulnerability to them, and they've been almost over expected to develop in these areas, and that's starting to flow through to the market now, where people become a bit more nervous. And you get those stories, of course, of a first-home buyer who's engaged in an off-the-plan property. It's 80% finished. Then the developer or construction firm goes into liquidation, and they need to find someone else to finish that property. All the while, they are paying their mortgage, and they might also be still paying rent as well. So the cost on those people, and the terrible personal story, of course, really hits home with them. But for now, from the research we've done, it still doesn't look like this is significant enough to really drive the market itself. It sucks for those people that are involved in that, but it's not enough to really suck the full market in with it. But it's one to watch for. And there have been some recent government announcements. They've got this build ready development pathway the government announced a couple of weeks ago, where they basically are trying to help out stored construction and provide a backstop for any business that does go into doing off-plan sales, that the government will buy them if they can't sell them to the public, and just give them that certainty, because there's nothing worse for an industry than uncertainty or lack of confidence in being able to keep getting sales to develop property down the line. And that's what we saw in the GFC. Consents got down to about 13,000 per year. We're at 50,000 right now. Back in the GFC, they got down to 13,000. That was the real bust cycle. And they know that. They're trying to stay clear of that and provide the support and certainty required. So I'm hopeful this time around we don't go through that, and the government's aware of it, hopefully putting things in place to stop that, to keep that industry up, and to keep that industry confident to keep getting those sales and keep moving forward.
Yeah, construction is just such a tough industry, and the fixed price contracts just ruins companies. You know, if you agree on a price and then half the materials you need go up by 7%, it's all your margin. And if you have a 3 month delay, the finance costs can just, there's no point in doing the deal to lose money. And that's one of the reasons we're trying to convince, well, warn clients and prospective clients about long settlements. Is you don't know what you're going to get in 6 months' time. You might not get the finished product. And if you are going to get the finished product, it might be with a new developer who's bought that other one out of liquidation. There'll be a new price and you have to put in more capital. So seeing that in Australia, a lot of construction companies liquidating, closing, stopping work simply because of those fixed price contracts and the length of time delay. People will not finish work if they're going to lose money doing it.
Yeah, exactly. I think there's so many more things to consider when you're going into, and off the plan and building and funding a build yourself, I suppose. But also, there's people out there that know what they're doing. I suppose I'm just wary of warning people against doing it completely, right? Like there's still
there's plenty of reputable companies that have been doing it a long time, that everything's done through trust accounts, and there's backstops and master bill guarantees and all sorts of things. It's the same as it always is. Buyer beware.
That's right. I think like anything for me, it's like do your research, right? Like don't just jump into it. Make sure you know what you're doing. Talk to a lot of people, and really find out what's going on with that business or that company or whatever it is. And make sure it's funded correctly, all those type of things, do your due diligence. It's even more important right now when there is more uncertainty and more potential for our economy to falter. And like you said, you don't know what's going to happen 6 months, 12 months down the line with that business. You also don't know about your personal situation too. Many of those people, first home buyers, also thinking about having a family in the future as well. And if that happens sooner rather than later, that affects your income. And so you've got to consider all those potential factors too. So I just think it's one of those ones that don't be scared completely away from, but no doubt you need to be very, very diligent about your research and ask a lot of people in the market about what's going on with the market and those businesses to ensure that you've got that confidence to carry on for what you say, could be a 12, 18 month or longer investment period until you actually get into that house.
Yeah, start with CoreLogic data, right?
That's the one, mate. Yeah, we've got plenty available.
So what are you guys seeing out of other countries or cities, Vancouver, Sydney, Melbourne, places in UK? Like what are interesting places that you're learning a lot from? Maybe Ireland as well?
Yeah, it's really interesting right now, mostly because everyone's looking to us. We are slightly further ahead in the monetary policy tightening cycle. Our downturn has come a bit faster and earlier than many others. And so particularly the Aussies are looking at us and going, what's happening in New Zealand? And that might, really forecast what could happen in those markets. So interesting that we're sort of leading the way this time around. So we're not really, paying too much attention to what's going on overseas. I think that, we do often look at Australia. That's a pretty easy one for us to look at and what's going on over there. There are some comparable cities, and you often see that similar trends will occur in places like Sydney and Auckland. So we've often looked at that one. When we look further afield, not particularly in the property market itself, but in some ways looking at what's happening in some of those advancing, I don't know what you call it, technology or those areas. And in the UK, particularly around things like energy efficiency. And when we talked about, healthy home standards, they're a bit further along that than us. And they've actually got much stronger regulation in the UK market. And CoreLogic's got a business in the UK as well. And so we are sort of looking at that and saying, well, what's happening in the UK? And are there any lessons we can learn to bring to New Zealand and get ahead of the game here? Because while there is healthy home standards, regulation could even get even tighter in the future, and we could assist with making sure that we are actually making properties not just warmer and drier, but more energy efficient too. And the whole, climate change and green, needing to be more green and stuff. That's a space that so many countries and businesses are getting into. And so trying to look over abroad and say, what are they doing over there? And what can we do to bring that more to New Zealand? And as a business at CoreLogic, how can we help facilitate that with our products and tools and all the data we've already got and the connections we have too, whether that be through government, banks, insurance companies, all those ones as well. So we feel like we are that kind of connector for the market that we can help to, make those things happen faster, that are better for all Kiwi that live here. So yeah, those are some of the things. And maybe the other one, actually, from a US perspective, is they're quite amazing at some of the work they do around hazard risk and identification.
Yeah.
And we know, again, how much climate change is affecting, flooding happening in New Zealand in particular. So particularly looking at and increase coastal erosion. And we've got some pretty cool modeling teams in the US with CoreLogic, and saying, what can we learn from those guys, again, to bring to New Zealand to help to bring a centralized data to help educate local government, central government, banks and insurance companies to make those decisions sooner, before we see such a cost that starts to be passed on to the consumer too. So yeah, some really interesting things going on in some new spaces, but really important ones too. So yeah, getting quite involved in those ones.
All right. Well, assuming that somebody wants to buy a property in the next 6 months, what tools and data should they look at based on what you guys provide, and also what other blogs or subscriptions or tools that are not CoreLogic would you also recommend?
Yeah, look, we have our data available. We have a property website called propertyvalue.co.nz. Much like many of the other property websites that are out there, you can go there and get all the basics of a property, and then you can also actually pay for the automated valuation from our model of what we value that property at, which is often the same value that the banks use when they're lending on that property too. So it's a good trusted value of what that property could be, but of course you do need to pay for it. So it's a little bit more expensive when you compare it to some of the free ones that are out there. So that's obviously a really good source of information. In terms of other blogs and information, look, I think many of the economists are people who I track. You mentioned Tony Alexander earlier. I do often try and keep up with what Tony's saying in the market. He's obviously been around a long time and has been through a number of different cycles and puts a good perspective on where things are going and where things are heading. So I think certainly paying attention to some of his take on things. He's also will talk about where interest rates are going. And I think that's a key consideration for anyone getting into the market, as well as expectation of interest rates, because you need to figure out how long you want to fix for. And, we'll do it for a number of reasons. Part of it's price. The other part is having certainty. And if you know that you might have a financial change, maybe you're more inclined to fix for a longer term too. And I'm sure that's more your area of specialty, Andrew, than me. You can try to advise what people do with their mortgages. But I think those are the other ones as well. But I think just reaching out to people in the industry as well, really talking to agents in the market in your local area. We put out some great content, but it is often nationwide. We have to generalize. We don't have specialists sitting in the Wairarapa or up in Taupō talking about what's happening in those markets. So talking to local people in your area who operate in those markets, real estate agents, mortgage advisors, business people, understanding what's happening from a business perspective and local economy perspective as well. Those are the people that will give you a good feel for what's going on. If you're an investor, understanding who your tenants might be, what sort of people live there and might be renting your property, and how big is that pool of people, which will then support you to get a decent rental price and hopefully not have the property vacant for a long period of time too. So I think that there's heaps of cool sources of information out there, but you cannot beat talking to people. And that goes for us too. We can sit behind our desk all we want, but we get so much from when we go and present at conferences, or we go and just be out there talking to people, and we get the feedback from the market. And sometimes we get information we've not heard, and we can go away and go, can we back this up with some data? Or maybe bust it with some data too and go, that was interesting, that was cool, but we don't see that happening market wide. There's maybe some unique situations too. So that's kind of how we operate. And I think for anyone that's, looking into buying a property, pretty big decision, pretty big commitment, make sure you do talk to a lot of people, do your research. It's not something to be taken lightly, and make sure you do your research.
Yeah, local agents is really good, and also local property managers. They'll understand what's being built or developed in the area that's going to bring new tenants in. And I think that the key thing when looking at the data is to not just look at property values or to just look at interest rates. Is you've got to overlay your own personal situation and think about return on capital and about alternative options to expand and grow your capital. So what do I mean by that? Let's say you buy $1 million property today. In 10 years, it's worth 1.3 or 1.5 or 2 million or 3 million because of inflation. In 10 years, it'll be hard to find people that say that it's going to be worth less than 1 million today because of so many factors pushing the property market up. But the thing is, when you buy the $1 million property, you don't put $1 million down. let's just pretend you put 200,000 of cash into the property and you get an $800,000 mortgage. That $200,000 of cash might be equity from your existing property, it might be savings, it might be, from various different sources. But in 10 years' time, if the property is only worth 1.3 and you haven't paid off a cent of your mortgage, you've still expanded your capital from 200 to 500,000. And it was a very low risk compared to other options and low effort investment. If you do nothing, you won't expand your capital. If you put your money into shares, you're probably going to have to like do allocations, stress about how you're invested in Apple or Tesla. If you're invested in a business, it's going to probably be a lot more high touch. So whether you think properties are going to double in 5 years or 25 years, you just got to compare the capital expanding options that property brings because of the leverage. And when you see reports from CoreLogic or from economists, very seldom do they consider the fact that people are not putting $1 million into $1 million property. They're putting a fraction and using intelligent leverage. And it's impossible for you guys to do that because everybody is on a unique pathway, right? Some people will put like 343,000 deposit down. Some people will put 600,000, right, with only 400,000 of leverage. Everybody is unique, and that's where you really, really, really got to understand the leverage.
Yep. I look, that's the absolute keyword, leverage. The fact that you can only put a smaller amount in and borrow the rest from a bank is unique generally to the property market. And I think that's obviously what's created the attractiveness in the past. And, as you said, the key thing has to be personal circumstances, your personal expectations, and your personal wants for most often retirement. And you look back at, basically the message has always been in New Zealand, how are you saving for your retirement? And most people have been encouraged, from central government or elsewhere to say, if you own a property, that has got to be one major source of you to set yourself up in retirement. Of course, now we've got KiwiSaver there. And then, generally people should have a KiwiSaver account, and that is going to be invested in broader shares and should increase over time as well. And so it's good to have multiple options. You don't want to be too, centralized to one type of investment. And that's good to have the diversity, of course. But I think the key thing is that you sit there and go, how am I? And that's why you need to talk to, financial advisors essentially and say, for me, planning to retire at whatever age, which is probably going to increasingly get older and older as we become healthy longer, and we just have to work to get the money to live healthy in retirement. So if you're going to retire at 70, for example, how much money do you need for 10, 20, 30 years, depending on how long you think you'll live, to live the life you want to in retirement? And how are you going to fund that retirement? And often people will say, well, you'd be sensible to have some form of property helping support that, whether it's just to live in or because you want some passive income as well. So I think that's why it's proved so popular. You probably want to be diversified and have other options there too, but that's certainly proven the case in the past, and there's nothing really to say that's going to change in the future. Certainly, the rhetoric coming from government is that they want to protect New Zealanders' greatest asset, which is property, and it's pretty clear that both National and Labor parties know that, and they don't want to see great falls in property prices because it would affect our broader economy so much. And, Bernard Hickey, the sort of economic commentator, I think his line is, we're not an economy, we're a property market with bits tacked on. And that's because so much wealth is tied up in property. And that is why all governments, no matter what the color is, they are wary of protecting that value to some degree over time, and that's likely to continue in the future as well. So could be an interesting election next year, but either way, property will probably be protected to some degree.
Yeah, there's more taxes coming because of capital gains tax being so unpopular. Both government arms will have to figure out how to make the money some other way, I guess.
Yeah, I mean, but from their perspective, it doesn't seem to be, or capital gains tax, I don't think it's necessarily a tax grab. It's not about getting more money. It's about whether people, depending on what you subscribe to and the data you see as to where, what's fair taxing, and the income tax gets treated differently to, income coming from capital. So, yeah, I think that's more of the debate than necessarily being a tax grab. But even then, you're going to get pretty political and get some pretty passionate views both ways, I suppose.
Yeah, it's a conversation for another day.
Indeed.
So thanks for your time, Nick. Anywhere you want to direct people before we finish off?
No, look, I think just to say thanks very much for having me. Calvin and I, our economists, we do have a regular podcast ourselves, which we release every Monday afternoon. So just search any podcast player for the New Zealand Property Market Podcast, and you should find us, or CoreLogic. You should come up on there. So that's a good one for our regular weekly sort of half an hour on the latest data and information on the influence that might have on the market. But all our blogs and data and house price index and stuff that we push out are all available on corelogic.co.nz. And then from a personal perspective, I am on Twitter, LinkedIn, always keen to connect with people on there as well. And my Twitter tagline is Nick Goodall _CL. So you can go and check me out and follow there. And certainly feel free to fire any questions or any thoughts through that we might have missed out on today. But yeah, Andrew, thank you very much for the time. Appreciate having me on. Always good to have a decent chat about the property market. So it's been fun.
Oh, good, man. Thanks. I'll let you go and talk again soon.
Superb. Thanks, mate.
Thanks.
Appreciate it.
Cheers.